Peter Lynch begins this chapter by calling out a long list of popular but dangerous sayings about stock prices. These phrases comfort investors, but they are mostly myths. He groups them mentally as the 12 silliest ideas people repeat, and his aim is simple: help you stop believing them. When you hear yourself saying one of these lines, it is a signal to step back and rethink. One of the most common myths is the idea that if a stock has gone down so much already, it cannot go much lower. Lynch tells the story of Polaroid and of Kaiser Industries to show how foolish that feeling can be. A stock can keep falling long after you tell yourself it has to stop, because price moves are not constrained by neat rules. The market can push a company to absurdly low levels even when, on paper, it seems cheap. That is why "it cannot go much lower" is no reason to buy. Closely related is the belief that you can always tell when a stock has hit bottom. Lynch compares bottom fishing to grabbing a falling knife. The right moment is nearly impossible to pick. A troubled company often vibrates along the bottom for years before recovering. Better reasons to buy a beaten-down stock are improving business conditions, a strong balance sheet, or verifiable evidence that the situation is changing, not simply that the price looks low. On the other side of the coin, people say, if a stock has gone this high already, how can it go higher? Again, Lynch warns this is a poor rule to live by. He points to long-term winners like Philip Morris and some smaller stories, companies that kept rising long after skeptics said the gains must be over. If the story is intact and the earnings keep growing, prices can climb much further than intuition says. Selling just because a stock has already done well often costs you the biggest gains. Another favorite line among casual investors is, "It is only $3 a share, what can I lose?" Lynch is blunt. A share trading at $3 can lose everything just as certainly as a share at $50 can. The absolute price per share tells you nothing about risk. The relevant question is the company's fundamentals, and whether the business can survive adverse conditions. Lynch also demolishes the comforting thought, "they always come back," the belief that every fallen company eventually recovers to its former glory. He lists many industries and companies that never returned: Hastings and Forgotten Fashions, obsolete technologies, bankrupt firms that never reappeared. For every iconic comeback, there are many companies that do not recover. So always comes back is wishful thinking, not analysis. He takes aim at the proverb, "It is always darkest before the dawn." That is another seductive but unreliable idea. Sometimes the worst point really is followed by recovery. Sometimes the darkness deepens into permanent decline. Examples from the oil rig business and railcar deliveries show how deep and prolonged declines can become. You should not invest on hope that things have hit the nadir. A related behavioral trap is setting a fixed price as a rescue plan, such as, "When it rebounds to $10 I will sell." Lynch points out that stocks almost never cooperate with these mechanical exit points. Stating such a rule often just perpetuates a bad holding. If you would not buy more at the current price, you should probably sell now rather than waiting for an arbitrary level. Lynch also knocks down the myth that conservative stocks do not fluctuate. Utilities and other historically steady sectors can and do suffer big declines when fundamentals or regulation change. No stock is immune to volatility. The idea that some equities belong in a safety deposit box and can safely be ignored is dangerous. Another temptation is impatience. It is taking too long for anything to happen. Lynch reminds us that many great winners went flat for many years before their breakout. Holding a good company requires patience, because the payoff often comes in the third, fourth, or even later year of ownership. This is where long-term compounding works its magic. Leaving too early means missing the biggest rewards. Two more behavioral errors he names are regret-driven buying and chasing the next one. "Look at all the money I have lost. I did not buy it," leads people to take reckless chances to try to make up for opportunities they missed. That usually means buying lesser companies in the hope they will become the next big winner. The better reflex is to ignore the list of missed fortunes. It costs nothing to have missed them, and trying to chase them will likely make you poorer. Finally, Lynch warns against judging an investment solely by short-term price moves. The stock has gone up, so I must be right. Or conversely, it has gone down, so I must be wrong, are dangerous shortcuts. Price changes only tell you that someone else was willing to pay more or less for the same company at a given moment. What matters are fundamentals, earnings, balance sheets, business plans, not the daily ticker. In closing, Lynch's message is steady and practical. Reject easy sayings. Test every claim against the company's story and its financial facts. Avoid mechanical rules that ignore business reality. Learn to tolerate discomfort because great returns usually require discipline and patience. If you do that, you will be better equipped to separate sensible investing from the dozen silly things people say about stock prices.